Have you noticed something strange about the silver market? One day, silver is racing toward $59, and within hours, it drops sharply, leaving investors confused. Now, here's the bigger question. Over the next few weeks, will silver explode toward $62, or will it first crash toward $52 before making its next major move? What if I told you that both scenarios are still possible? And more importantly, what if this period of volatility is actually setting up one of the biggest opportunities precious metals investors have seen in years? Stay with me because by the end of this analysis, you'll understand why the next few weeks could determine the direction of silver for the rest of the year. Welcome back to Macro Bullion. I'm Alex James, your independent macroeconomic and precious metals analyst. On this channel, we don't chase hype, fear, or social media rumors. We focus on macroeconomics, market structure, gold, silver, central bank policies, and the real forces moving global markets. If you're serious about understanding where the economy and precious metals are heading, you're in the right place. Let's begin with the one metal that usually leads the entire precious metals sector, gold. Professional investors often say, where gold goes, silver eventually follows. That relationship has repeated itself throughout history, and today's charts are giving us another important signal. Over the past several months, gold has not been making dramatic new highs. Instead, it has been trading inside a narrowing price range. Many technical analysts describe this as a descending wedge, a pattern that often develops before a significant breakout. According to the source material, momentum indicators like the Relative Strength Index, RSI, have begun strengthening even while prices have remained under pressure, creating what technical traders call a bullish divergence. Now, let me make something very clear. A bullish divergence does not guarantee prices will move higher. Technical analysis is based on probabilities, not certainties. However, history shows that when an established uptrend pauses inside a descending wedge and momentum begins improving, the chances of an upside breakout generally increase. That's why many experienced analysts continue watching gold very closely before making their next move. If gold successfully breaks higher, silver could receive another wave of buying interest. But if gold fails to hold its current support levels, silver could experience one final sharp correction before recovering. That is exactly why the next few weeks matter so much. Now let's turn our attention to silver itself. The silver market has been extremely volatile. According to the source script, spot silver recently traded close to $59 per ounce before falling sharply to around $56.46 within a very short period. That kind of price swing is normal for silver because it is a much smaller market than gold, meaning relatively small buying or selling pressure can create large percentage moves. Naturally, investors started asking the same question: what caused such a dramatic decline? Some market participants blamed routine futures market activity, while others argued that heavy selling during London and New York trading sessions once again pressured prices lower. The source script reflects those opinions and discusses claims about COMEX and LBMA price pressure, but it's important to note that these are viewpoints expressed by commentators rather than independently verified facts. Regardless of the explanation, one fact remains undeniable. Silver continues to experience unusually large daily swings, and that volatility often shakes weaker investors out of the market. Yet experienced long-term investors tend to view volatility differently. They understand that temporary corrections are common in every major bull market. Markets rarely move in a straight line. Instead, they test investors' patience before revealing their true direction. So here is the critical question that every precious metals investor should ask right now. Is this simply another temporary shakeout before silver moves towards $62? Or is the market preparing for one final correction that could push prices closer to $52 before the next major rally begins? That is exactly what we'll uncover, where we'll examine expert forecasts, the US dollar, global macroeconomic conditions, and why several powerful catalysts could soon decide silver's next major move. Now let's step away from the daily price charts for a moment and focus on something much bigger. Because if you're only watching silver move $1 or $2 every day, you're missing the real story. The real drivers of precious metals aren't just technical patterns, they're global economic conditions, central bank decisions, inflation, employment data, and geopolitical uncertainty. These are the forces that shape long-term trends, and right now, several of them are coming together at the same time. One respected market commentator quoted in the source points out that gold and silver have remained surprisingly resilient despite a combination of geopolitical tensions, volatile energy prices, rising bond yields, and changes in expectations surrounding the Federal Reserve. His conclusion is simple: the precious metals market appears to be waiting for its next major catalyst. When you think about today's global environment, it's easy to understand why investors remain interested in safe haven assets. Inflation may no longer be making headlines every single day, but it continues to affect household budgets around the world. Government borrowing remains historically high. Financial markets are still adjusting to higher interest rates, and geopolitical risks continue to create uncertainty across multiple regions. The source also highlights ongoing international tensions, including developments involving Iran and the continuing war between Russia and Ukraine, as examples of geopolitical uncertainty that many investors believe support demand for gold and silver. These events can influence investor sentiment, although their impact on metal prices is never guaranteed and often depends on broader market conditions. Now let's talk about one event that every serious investor should monitor this week: the U.S. employment report. According to the source material, market participants are paying close attention to the July employment numbers, with expectations centered around a key payroll figure. The commentary suggests that if job growth comes in significantly weaker than expected, financial markets could react quickly because employment data heavily influences Federal Reserve policy expectations. Why does this matter so much? Because the Federal Reserve has one of the biggest influences on financial markets. If employment weakens substantially, investors may begin expecting easier monetary policy in the future. Lower interest rate expectations often reduce support for the US dollar, while improving the outlook for non-yielding assets such as gold and silver. On the other hand, if employment remains stronger than expected, markets may continue pricing in higher interest rates for longer, creating additional short-term pressure on precious metals. That single economic report could therefore become the spark that finally pushes silver out of its current trading range. The source outlines two possible short-term scenarios. The first is a temporary decline into the low 50s, or even toward the $48-50 area, representing what many traders describe as a final flush-out of weaker investors. The second scenario is a decisive move above recent resistance, opening the door toward approximately $62 per ounce. These are forecasts discussed by the speaker in the source and should be viewed as market opinions rather than verified outcomes. As independent analysts, we shouldn't become emotionally attached to either prediction. Instead, we should ask ourselves a more important question: what evidence will confirm which scenario is actually unfolding? Professional investors don't predict first and look for evidence later. They monitor incoming data, evaluate market reactions, and adjust their outlook as new information becomes available. That disciplined approach is far more effective than simply hoping the market moves in one direction. And while everyone is focused on employment numbers, another story is quietly developing behind the scenes. Major developments in Japan's financial system, currency intervention, and rising government bond yields are beginning to reshape global capital flows. These changes may seem distant from the silver market, but they could have significant implications for the US dollar, global liquidity, and ultimately precious metals. That's exactly where we're going next. We'll examine why Japan's currency intervention, China's monetary policy, rising global debt, and changing investor confidence could become some of the most powerful long-term catalysts for gold and silver. Now let's move beyond gold and silver for a moment and look at something most retail investors completely ignore: the global financial system. Because sometimes the biggest moves in precious metals don't begin inside the metals market. They begin in the currency market, the bond market, and inside central banks. And today, one country deserves everyone's attention: Japan. Why is Japan so important? Because Japan isn't just another economy. It is one of the world's largest creditors, one of the biggest holders of US government debt, and a critical player in global financial markets. When something changes in Japan, investors around the world pay attention. According to the source material, Japanese authorities have been making significant efforts to stabilize the Japanese yen, while reports also discuss coordinated market actions involving US authorities. The commentary argues that governments generally don't intervene in currency markets unless they believe there is a serious financial issue developing beneath the surface. That interpretation reflects the speaker's opinion, but it highlights why many investors are closely watching developments in Japan. Now think about this from a macroeconomic perspective. For years, Japan maintained extremely low interest rates. That encouraged global investors to borrow cheap Japanese yen and invest the money into higher return assets around the world. This became known as the yen carry trade. But what happens when Japanese interest rates begin rising? Suddenly, borrowing yen becomes more expensive. Investors who borrowed billions of dollars worth of yen may be forced to unwind those positions. That can create volatility across global financial markets, including bonds, stocks, currencies, and even commodities like gold and silver. This is why macro investors are paying close attention to Japanese bond yields instead of focusing only on today's silver price. At the same time, another major economy is quietly adding support to the precious metals story: China. According to the source, the People's Bank of China announced a 50 50 basis point reduction in the reserve requirement ratio for eligible financial institutions. In simple terms, Chinese banks are required to hold less money in reserve, allowing more liquidity to flow into the financial system. The source suggests this additional liquidity could provide a supportive environment for gold demand over time. The source also mentions reports of rising premiums for gold jewelry in China, suggesting strong consumer demand despite already elevated gold prices. While the exact figures referenced in the discussion were not independently verified within the source itself, the broader point is that physical demand remains an important factor to monitor. Now let's zoom out even further. Beyond Japan, beyond China, beyond daily market volatility, there is one issue that continues to dominate the global economy: government debt. The source highlights the rapid growth of U.S. national debt, approaching the $40 trillion milestone. The commentary argues that once this psychological threshold is reached, it could attract much greater public attention and encourage more people to question the long-term purchasing power of fiat currencies. These are forward-looking opinions expressed in the source rather than verified future outcomes. Why does this matter for gold and silver? Because precious metals have historically been viewed by many investors as a hedge against currency debasement, inflation, and declining confidence in paper money. If debt continues expanding faster than economic growth, concerns about long-term fiscal sustainability may increase demand for hard assets. The source also reminds investors of something many people forget during quiet markets. Physical silver can appear plentiful when demand is normal, but during periods of financial stress, supplies at dealers have tightened in previous market cycles, resulting in higher premiums and longer delivery times. That observation is based on historical market behavior discussed in the source. Now ask yourself one simple question. If global debt keeps rising, if central banks continue injecting liquidity, if geopolitical uncertainty remains elevated, and if investors begin losing confidence in fiat currencies, what happens to demand for real assets that cannot simply be printed? That is exactly the question every serious precious metals investor should be asking today. We'll connect every piece of this macro puzzle together. We'll examine the long-term outlook for gold and silver, discuss what could happen after the next major breakout or correction, and I'll share my independent conclusion on where this market may be heading over the coming months. We've now examined the charts, the technical indicators, the dollar, global currencies, central bank policies, geopolitical risks, and the growing debt burden facing major economies. So now comes the question every investor wants answered: where do gold and silver go from here? The truth is that nobody, not Wall Street, not central banks, and certainly not any YouTuber, can predict the exact price of gold or silver next week. Anyone who promises certainty in financial markets is selling confidence, not facts. As independent analysts, our job isn't to predict the future with absolute certainty. Our job is to analyze probabilities, monitor the data, and prepare for multiple outcomes. Based on the source material, the silver market is approaching one of its most important decision points of the year. The discussion outlines two primary possibilities. The first is a short-term correction that could temporarily test the $50 to $48 area before buyers return. The second is a successful breakout that carries silver toward the $62 level and potentially opens the door for an even stronger rally later in the year. These are scenarios discussed by the source speaker and should be viewed as market opinions rather than confirmed forecasts. Now let's think about the bigger picture. Ask yourself these questions. Has global government debt stopped growing? No. Have central banks suddenly become less active? No. Has inflation permanently disappeared? No. Has geopolitical uncertainty ended? Absolutely not. In fact, many of the structural challenges supporting long-term interest in precious metals remain firmly in place. That doesn't mean prices will rise every week or every month. Markets never move in straight lines. Corrections are normal. Volatility is normal. What matters is whether the long-term macroeconomic trend continues supporting demand for hard assets. One of the most interesting points raised in the source is the growing attention surrounding the U.S. national debt approaching the $40 trillion milestone. The discussion suggests that once this level becomes a major public headline, more investors may begin questioning the long-term purchasing power of paper currencies and consider diversifying into assets such as gold and silver. That is the speaker's interpretation, not a verified prediction, but it reflects a concern shared by many macro investors. The source also highlights the long-term trend in U.S. Treasury yields, noting that bond yields have been rising after decades of decline. Higher yields affect borrowing costs, government financing, equity valuations, and precious metals. Monitoring the bond market will therefore remain just as important as watching gold and silver prices themselves. From my perspective as an independent macro analyst, the next few weeks should be watched carefully, not because they guarantee a breakout, but because they may provide stronger evidence about the market's next medium-term direction. Key economic data, Federal Reserve expectations, bond yields, the US dollar, and geopolitical developments could all influence investor sentiment. Whether silver first dips toward lower support or breaks above resistance, disciplined investors should avoid making emotional decisions based on a single trading session. Instead, focus on the broader trend, manage risk carefully, and always have a plan before entering any investment. Remember, successful investing isn't about catching every dollar of every move. It's about staying informed, staying patient, and making decisions based on evidence instead of emotion. If today's analysis helped you understand what's really happening beneath the surface of the gold and silver markets, let me know your opinion in the comments. Do you believe silver reaches $62 first, or do you think the market still needs one final correction toward $52 before the next major rally begins? I'd genuinely like to hear your view because healthy debate helps everyone become a better investor. If you're new to Macro Bullion, don't forget to subscribe and turn on notifications because every week we break down the biggest developments in gold, silver, inflation, Federal Reserve policy, global debt, and the macroeconomic forces shaping financial markets. Our goal isn't to create hype, it's to provide balanced, fact-based analysis that helps you think independently. Until next time, I'm Alex James. Stay informed, stay patient, protect your capital, and as always, do your own research, DYOR. Disclaimer, this content is for educational and informational purposes only. It does not constitute financial, investment, or legal advice. Market conditions change rapidly, and past performance does not guarantee future results. Always verify current market data from reliable sources and consult a qualified financial professional before making investment decisions.